Hello guys, and welcome to this special educational webinar. My name is Alejandro Zambrano and I'm the Global Chief Market Strategist with ATFX. I'm also the Editor-in-Chief with investingcube.com. You should be able to see my screen. If you can do that, please just type Y or a yes in the chat box. As well, if you do have any questions at all during the presentation, you're most welcome to put them in the chat box here, and I'll do my best to try to help you. Okay, so we have a lot of people here, which is really good. We got Vladi, we got Diana, Sunbi, Holly, and Joanna, and Derek, and Jitin in the chat talking with me, or saying helping out here. We also have more people just watching. Guys, thanks so much for joining me this evening. If you're totally new to this, ATFX is a broker based in London, and I'm sitting in London myself here in our offices, just like a stone's throw away from the Bank of England. And I've been doing this for quite some time. So let me introduce you to myself. If you're new to me, my name is Alejandro Zambrano, and I'm the Global Chief Market Strategist of ATFX. That means that I manage a team of different analysts in different parts of the world, and I also manage the website called investingcube.com. Afterwards, I would gladly welcome you all to investingcube.com so you can learn more about the site. We produce educational content, but actionable. So it's news and education really. Start news and technical analysis. That's probably better. Looks like this, the site. We are having latest news on top, and then we have Forex, commodity, indices, and cryptocurrency news. We also have quarterly market outlooks, and we have an online trading summit where I invited a few famous guys here in London that are all traders. This gentleman was part of a BBC interview. This guy here is really famous, has about 250,000 followers on Facebook. He's famous as well for turning 3,000 into a $100,000 account by trading the markets. Sakmir as well has been around for a very long time. That's me again. And we have also Ian Foster, which has been trading, I think I know he's been trading since 1980, but he's been having an educational school, I think, since 1998. And then we have Angeline, which was one of the ladies that set up Baby Pips. You might know that site as well. I'll send you that link. You can check that out later on. But this is it's investingcube.com. Okay, so why should you spend the next half an hour with me then? So obviously I'm the global chief market strategist. I've been with different firms. Some of you guys might know FXCM, which used to be a big currency broker. And I used to work for them between 2009 to 2016. And FXCM used to own the website Daily FX. So you might know me from there. I used to do a daily webinar at Daily FX, and I used to write articles. So being with FXCM, which at the time was one of the world's biggest brokers, and also working on Daily FX, taught me a lot about the different markets. I have, of course, also been trading myself since 2006. So I've been doing what a lot of you guys are doing today, which is to trade with your own real accounts and trying to figure out how the markets really work and try to create an extra income with the help of my training. I can tell you it wasn't easy, and it's been taking a lot of time. But since 2014, I actually managed to turn profitable in my trading. So if you do have any questions about any strategies or nothing at all, or anything similar to that, you're most welcome to reach out. Now, you can see as well here, I feature sometimes on TV. This is CNBC, where I feature maybe once or twice a month. I also do a few other TV channels, and also I'm in the written press. And I've been pretty much all over the world to host presentations, places like the UK, of course, Italy, Sweden, Greece, Spain, Dubai, Lebanon, Hong Kong, Singapore, and Shenzhen. So I've pretty much been most places in the world talking about the markets. Okay, let's begin. So before we begin though, I need to show you this risk disclaimer. I know some of you guys have been training for a long time, so you know exactly what this is all about. But for anyone that is new here, I need to tell you guys that trading financial markets unfortunately is high risk, and there's a genuine risk that we lose all of our invested money. In fact, in Europe nowadays, all the brokers need to disclose how much their clients, the percentage of their clients that have lost money. And most of the brokers are around 69, 72%, and ATFX is at between 70 to 72% of the clients lose money. Of course, you're here to learn, so hopefully after this, you will be able to actually improve your trading. And if not, if you're very good at what you're doing, maybe learn a few new things that you can maybe implement, so you'll have an additional strategy to work with. Okay, let's move along here. So what's the title of the presentation then? Minimum effort, maximum results, low upkeep trading strategies. Now, I probably should have written this slightly different because we're not really necessarily going to deal with trading right now, but we're going to deal maybe slightly a bit more about investing, a bit of a different way of making money. So in my own way of dealing with my money, I have money set aside in a case of an emergency. Say some reason I can't work and I need money, so I have money for a few months, or if someone gets sick and we need to pay for special medical care or whatever it could be, I have that set aside. Then I have my trading account, which is a normal trading account that most people have, and that's my speculative money. And then I have pension savings and longer term money, where the idea is to have that money to be able to retire one day and be able to retire without worrying too much about money. And the strategy I'm going to talk about today has more to do with that than the short term, but you can of course use some of these techniques in short-term trading as well. So what is the best and easy low upkeep strategy around? It's actually stock markets. And what you're looking at here is the S&P 500. You have data from 1971 all the way up till today. And really over this period, the markets have risen with almost 5,000%. Doesn't mean though that it hasn't been without any problems, as you can see here, from the year 2000 all the way up pretty much to 2015, this market was trading sideways. And one of the techniques I'm going to share with you guys is how to still be able to make some money in these situations where the market is just trading sideways. Of course, when the market is going up and up and up, it's very easy to make money. But when the market is trading sideways, that is when it becomes a challenge. So let's take a look a little bit at the best stock markets in the world, because not all stock markets are actually great, and we need to be a bit careful here with figuring out how to invest our money. And I would like to focus on these markets here primarily. Now, it's a bit difficult to say group things together, but it's quite clear, at least looking at this, and this is returns between 1971 and 2012. And this is after inflation returns in these markets. You can see that the Swedish stock market on average gives you 9.61%. The South African stock market gives you an average of 8.48. The Finnish stock market 7.82. The Danish market is 7.6. The Dutch market 6.6. Norway 6.39. UK almost 6%, and US 5.72. I think most of you guys are very well familiar with these, and probably even some of these as well, like the DAX 30 is very, really popular. But you can sort of get an idea here and get a bit of a gauge of what to anticipate. And it's not bad numbers. It's not bad numbers at all. If I just bring out a calculator and compare this with keeping your monies at the bank. At the bank, you really don't get any return, right? So say that we are investing in the Swedish stock market, and we are aiming for the average return, and then we do that for 4 years. How much are we going to make? we're going to make 44%, which is actually not that bad at all. And something which is quite striking is you have Sweden, Finland, Denmark, and Norway. All of these countries are in Scandinavia and the Nordics. And what's quite interesting with these countries is that they're actually small countries. Like Sweden has maybe 9.3 million inhabitants. I think Norway and has maybe 4 or 5, and I think it's something similar with Denmark. Finland as well is not really that big. And you also have the Netherlands here, which is another country which is very small. Because these countries are very small, it's easy to say manage education, so they're highly skilled. Most people study finish school and study higher education. And they're also very, very export oriented, and they're investing a lot in innovation, which you do when you have a highly qualified, highly educated population. And I think that could be something that could actually give them a bit of an edge. But you do also have the US up here, which is obviously very known for being a very agile country where you can set up a business and easily get that running without too much of a corporate hassle. So those are sort of some key countries to keep an eye on. There are some other countries as well, like South Africa, obviously has high unemployment rate, has its own problems, but we need to be a bit careful with some of these countries. Like South Africa's on top. Australia, I know for a fact, if you would look at the numbers for the last 100 years, then Australian stock market is also one of the top one. But you need to be careful with a stock market like the Australian stock market because it's so centered on mineral exports and, for example, copper production, iron ore production, and that is obviously very, very closely linked to China. So when things are good in China, all these miners do very, very well, and the Australian stock market does well as well. But when China does not good, then at one point they're going to stop building. It's not going to continue to build housing and housing and housing after housing. Then obviously the Australian stock market will not really do as good. So you need to sort of focus on stock market indices that are more diverse. And for most people, the US one is very good. As you know, you have big tech over there. You got Google, Facebook, you got Amazon. So you have all of these innovation and big companies in the US that are really leading things. And then you have these countries here as well: Sweden, Finland, Denmark, Netherlands, Norway. Norway is also unfortunately quite tilted towards crude oil, but you have all these countries. We have a diverse set of companies that do good. Now, what do you need to pay attention to, or how come stock markets always go up? Like, what is this? How come it's always going up? In general, the stock markets show the health of the biggest companies of a country, right? So as long as the country is growing and developing, the corporations that exist within that country tend to see higher valuation. Why? Because companies it's just a part of their economy, right? So as long as the economy is gaining, you tend to see a strengthening of the stock markets. So I got a question here as well. I'm an Indian stock market trader. Will I get some knowledge about the Indian stocks? We're not going to cover any emerging markets or like Indian stocks right now, unfortunately. I'm sorry about that. Um, but you can still potentially use this information to understand how you can potentially trade Indian stocks. So the blue line here shows GDP, and I have linked it so that it shows the growth from 1971. So from 1971, the US economy has gained with almost 2,000%. Over the same period, the US stock market from that year, by the way, has gained with about 3,400% according to this chart here. So you can see that they're moving together. Sometimes the stock market grows much faster than the economy. When that happens, the stock market tends to converge, and that is when valuations get too hot. When people anticipate, because obviously they will buy, people buy, for example, Facebook today because they think they're going to become a better company in the future. I'm going to talk about that in a minute. So what happens here, sometimes, like here, for example, from the 1980s up to 1995, the world economy or the US economy was growing and growing and growing and growing and growing. So the economy was richer, it was better, but the stock market was lagging behind. So what happened is that eventually stock market started to catch up. And then stock market started to gain a lot of momentum, and they gained and they gained, and then everybody got a bit crazy about it and said, "Oh wow, look, stock markets are going up, so I'm just gonna be buying because I want to buy and make money on the move to the upside." And they pushed the market all the way to the upside. Now up here, eventually people realize, hold on, these companies are not necessarily making money. This was in when it was all about the IT bubble. You might remember that. People, if we just set up a web page and you could show that you're getting hits, people thought that you can take that website and convert that and make money. But what happened eventually, people realized that these companies are just losing a lot of money. They're not even making any money. And then stock markets collapsed. And then they went all the way up, and you might remember it was the heydays in Southern Europe, places like Spain. People were buying flats. You had a lot of people owning not just one flat, but two flats, three flats, and in places like Greece as well. But then the market collapsed and went lower because people realized that these people, they couldn't afford what they were paying for. To give you an idea, I was working in London in 2010, and I used to work at the Gherkin, which is a very nice office here in London. Uh, it's a nice tower. Let me show you it. So it looks like this. So I used to work here in London in this building, and the cleaner there was from Spain. And I'm like, how come you moved to England to take care of the cleaning in this building? And he told me that he lost his job in Spain and had to move to London to get a job here to be able to pay for his houses. He had three buildings or three apartments that he had bought at the very top, and suddenly he couldn't service the debt, and um, he had to get another job in another country. But in general, what I'm trying to say here, as long as you are investing in the stock market of a country that is healthy and is growing, most of the time stocks in that country tend to go up. And as you know, the US economy is very pro-business and will probably continue to be pro-business for a long, long time. That's why people really want to invest in the S&P 500. But there are occasions like this one when you'll see a situation where the stock markets rally strongly. Like right now, for example, you could argue that the stock market has risen far faster than the economy has done. And when you tend to have recessions, you can barely see it, but when the economy contracts a little bit, you tend to see stock markets moving down substantially lower. Now, how come stock markets move substantially lower? Well, it has to do with the fact that people don't buy stocks today because the value of the company today. Most of the time, they buy stocks today because they think that that company is going to do better in the future. One way of illustrating this is to use what we call the PE ratio, price over earnings ratio. What does that mean? The last reading shows that the PE reading was at 23. That means that if you take all the companies in the S&P 500 today, say that they make, for the sake of it, they make $100 per year, all the S&P 500 companies. Well, right now, sorry, let's make it even simpler. Say they make $1 per year, all these companies. Well, right now, the exchange, all the companies are valued at $23. So effectively, if you buy the S&P today, and these companies just produce $1 per year, and they'll do that for the next 23 years, then it will take 23 years before you got a full 100% return on your investment. Does that make sense? So effectively, the PE value here is telling you that people are buying stock markets today because they think that either that the companies are going to make more than £1 or $1 per year, or that they think that they will make $1 per year for the next 23 years. So effectively, people have a 23-year view on the stock market. And that is where we have these volatile situations in the markets, like here when the market collapses down and sometimes recesses quickly, because a small little change today, like US and China trade wars, if they make small changes today, then that's going to affect the ability of these companies to operate over the next few years. It's the same thing if like President Trump, he cut taxes, right? For corporations, they're very rich, and also people with less money in the US after he became president in 2016. That changed the rules a little bit, and that affected the valuation of stock markets. Here's when he got elected here, and this is in 2016, and following those rate cuts in anticipation to what he would do, the market rallied strongly. And then from 2018 all the way up until now, the market hasn't really moved so much because firstly, it moved up quite a lot already, and then they were worried about the trade wars potentially causing the economy to go into a recession. And if it wouldn't go into a recession, then this would have come down tumbling. So what's sort of your typical volatility in something like stock markets? Because if you look at this number here for the US, on average, the US stock market will produce 5.72% per year, okay? However, on a short-term period of time, is much, much more volatile. The recent slide you saw in the S&P 500 in December of last year saw a decline from the highest level to the lowest level of 18.2%. So that's an 18.2% decline. That's much higher, like twice, or well, almost 4 times the average return in the stock market. And when we have recessions, we have this big slides like we saw here from the year 2000 all the way to 2013, a big slide of 47%. And then you have a big slide here of 48%. And then throughout the years, it's rather common to once in a while have a 28%, 30% slide, as you can see here. And then most of the time, you have some smaller declines as well. The declines nowadays tend to be less aggressive, as you can see here, because you have the central bankers. As soon as the economy goes bad, they go ahead, well, stock markets go bad, they start to calm the markets by saying that they're going to lower interest rates, maybe introduce some quantitative easing. So how should you think then? How should you think in the case of these recessions? When you have these massive recessions, the way I look at it, if someone tells me to invest in a country where there's a lot of political uncertainty, say, for example, a country where the president is happy to break the constitution to stay in power for more than what is normally allowed. So most countries, you can be president for 2 terms out of 4 years like they do in the US. But in some places, particularly in emerging markets, you have a lot of power concentrated in a few people. Democracy is nothing that you can take for granted. You know, if you say the wrong things, you know, you might end up in prison and so on and so on. But if you look at countries where democracy is strong, where you have the right to set up your own business and no one's going to take that from you, where you can trust that the tax system and the laws are not going to change too much, and it's a healthy economy, maybe like the Scandinavian economies, as I talked about, maybe also the US economy, and even some emerging economies. In those countries, if you have strong belief that you think that, well, the economy is definitely going to do better in the next few years, then when you have these big slides, the general idea is actually to buy more. I know this sounds counterproductive or counterintuitive, and you think that, hold on, if the market is crashing, you know, should I really be buying more? Well, as long as the country you think is going to be better in the next few years, then actually you want to buy more. And this is exactly what this is telling me. If you would have bought, you know, even if you would have bought here in the S&P 500, eventually you would have made your money. So how can you sort of ensure that you actually make money even when the market is really quiet the way it is? Well, it's about averaging in. And you might say, hold on, averaging in short-term trading and leverage trading is a bad strategy. I agree. When you trade with leverage, what a lot of people do, for example, with ATFX, you trade with leverage, then there's a high risk that you can get what we call a margin call, and you can actually lose all of your money. It has nothing to do with the fact that it's ATFX. It could be with any leverage trader. The problem is when you trade with leverage is that you trade more than what you actually have on your account. In the case of when you buy the S&P 500 directly, or you could also, if you wanted to trade it via CFD, via ATFX, as long as you have no leverage. So what does no leverage mean? Well, if you have $10,000 in your account, that means that your maximum position in the market will be 10,000, which means that if you buy something for 10,000 and the market collapses with 50%, then you have 5,000 left. When you trade with leverage, on the other hand, you can usually buy for more than you have on your account. So say you have 10,000 on your account, but you buy for a position for 20,000. Well, that's 2 times you have on your account. So when the market just goes down with 50% in your account, you would have lost 100%. And that's when this does not work. So what is this then? Well, imagine you buy the S&P 500 is at 10 and you buy that in March. And then you have a decline. It's a decline of 20% and now the S&P is at 8. And because the market went down, you can buy more of the S&P for the same money. Here, you bought a bit more, and then 2 months later, the market moved up higher. But because you bought here and here, when we back up here again, you're breaking even. And then a few months later, we're back up here again. So you made 20 or 2 on this one, because you have 2, 9, 10, and this one is now back at break even. So a very, very simple strategy is just to average in, especially when you have these declines, these short-term declines, because most of the time a recession and a decline goes really quickly. It takes maybe 1 year, sometimes 2 years, but most of the time it just takes 1 year. Like here, for example, in 1988, the market collapsed really quickly. Here as well, collapsed quickly with 18%. And then there was a big recession, took about 3 years. This one took about 1 year. The biggest problem, though, is that we have no idea when this is going to happen, but they tend to come in cycles. So we haven't had a massive recession now for 10 years, and we're probably due for one. So maybe in the next few months or years, we can have that big decline. But as you know already, unless you think, for example, the American economy is going to change dramatically, well, when we have a 40 or 30% decline, it's usually a good time to buy. And in the meantime, though, you have all these short-term corrective moves, which again is something that can be bought as long as you have belief in the economy you're investing in. So that's a very, very simple low upkeep. And this does not have to contradict with what you're doing in your other accounts. You can have your pension and savings account separate. And then you can have your trading account with a broker like ATFX, which allows you to trade indices, currencies, commodities, and cryptos. Doesn't have to be contradicting. In fact, you might be long here, but then you're using ATFX to hedge your position by going short at the highs. That's one example. And this sort of strategy, you can easily try to replicate something like it by trading in the short term as well, by averaging in. The only thing you need to think about though when you average in is that you do not risk too much money and try to limit the amount of leverage you're using. So I hope that makes sense. So that's a simple low upkeep strategy that I've been knowing for many years and I've been implementing. I know as well a lot of my friends have been implementing that. They have a certain amount of money going into stock markets on a monthly basis. And it doesn't have to be a lot of money. It can be whatever you want to invest. Most people recommend you save maybe 10% of your monthly income and put that into savings. Okay, let's see if you guys have any questions. As well, if you just arrived, thank you so much for joining me. We talked about a simple strategy and how to invest in stock markets. I explained a little bit why stock markets go up, and that has to do with the fact that the economy, as long as the economy is improving, you're going to do good. And you look for countries with strong democratic settings, and that also allows companies to thrive. Ideally, companies or countries with a highly educated population that can drive innovation. And if you don't have access to that, the S&P 500 is an excellent country as well to invest, even though you have some of the Nordics that actually been a bit better over the last few years. As well, we've got a question here actually, if we're going to cover Forex in this webinar. So this specific webinar, no, we're not covering any Forex, but this gentleman here, Charlie Burton, he is a Forex trader. He's been trading for 22 years and 8 of them have been full-time. So he trades Forex. You also have Ian as well to trade Forex and Zach as well that trade Forex. And myself, I trade Forex and Angeline as well. And this is that special online trading summit that we're going to have in 10 days. It's going to be on a Saturday on November 30th between 10 a.m. till 3 p.m. London time. You have the link there in the chat. If you register, it's free to join. And you're going to be able to join. It's going to be similar setting like this one. And it's going to be various talks. So you can hopefully learn a bunch of few strategies during this event. What do I think about investing in the Chinese stock market since it's growing so fast? Let's take a look at the Chinese stock markets, right? So there's different ways of accessing that market. So there's the China, it's called the China A50. If you're a foreigner, the China A50 is the market that you can invest in. However, though, it's extremely volatile, and I would probably leave this for your CFD account. So, for example, with ATFX, you can actually trade the China A50, and like any other index. The different markets they offer. Let me show you here. That's the link to that page. As well, before I forget, I do have a Twitter account if you want to stay in touch. That's the link to my Twitter account. I also have a WhatsApp channel. If you want me to add you, you can get my daily webinars. You send a message to that link. Now the reason why, so with ATFX you have the China, it's called the CHI 50. Now the reason why I would probably keep this to my CFD account is because this one, while it moves a lot, I mean, while it goes upwards, it's extremely volatile. Like here in March 2014, you know, the market made 129%. And then this market here came down tumbling with 43. And this was in from 2014 to 2016. Here the market gained with 69%, and then they came back down tumbling here with about 30%, and now it's moved up quite a lot. But the thing here with this market, it actually is a bit too volatile, really. It's much more volatile than the S&P 500. So this one you can still use the averaging technique, but to give you an idea, from 2011 until now, it's up with 74%. The S&P 400 from 2011 is up with 190%. So up with 190%. China 50 is up with 75%. So the US stock market has delivered more than twice the return, but the volatility in the US stock market is less high. So the US stock market is a much more stable one. One simple reason for that this is just 50 shares. The S&P 500 is 500 shares, so you get less volatility. But this one is great to trade. You can do like breakouts and normal trading with this one. I remember actually in 2014 how I bought a little bit here. I remember this very well. I think I made this little move here, some 10-15%. And back then, you know, 10-15%, I mean, 15% on any sort of investment like this one is a good move. But I remember here, the market went totally crazy and went up with 117%. It's a little bit like Bitcoin, right? It just went crazy. So this one is not really a long-term index to invest in. You have the Shanghai. You have Shanghai Composite, which again, unfortunately, hasn't necessarily. Actually, this one is not that bad. So from 2011, the market has risen with 18%. So it's not necessarily an amazing market, because you see what happened here is that the Chinese economy developed from very low levels into a well and stable economy. And I think after that, it's been much more difficult. I know that Sensex, the Indian stock market, is far more interesting, at least in 2014. This is the Indian stock market. This one is up with 147%. And this one you can see as well has a nice stable trend. In the longer run here, because buying on dips is the better strategy. You ask yourself, how can I become an expert on these different countries then? You don't always have to be an expert on all these different countries. You know why? Because the clever people and people with money in China, in India, and in other places of the world, they will invest. So they will buy on these strong dips in the market because they have an understanding of the economy. So when the market declines sharply like this one here, they know, actually, I want to buy some of the Indian stock market. So you don't actually have to necessarily be an expert on the world economy, on the different economies, because the index itself is gonna let you know if it's worthwhile investing in just by looking at the chart if it has a trend or not. Very good question. Bloody says, how about the fees? Holding S&P for a very long time, wouldn't that eat my earnings? If you're looking to do the long-term investment, then I would recommend ETFs. So an ETF, depending on where you are in the world, maybe it's going to cost you 75 basis points, so slightly less than 1%. That could be a good option to trade or to invest. And remember, to do the strategy I'm talking about here, you will probably need to keep the money for at least a year, if not two. And in worst case, if you get caught out in a massive recession, you would need to hold it out for a little bit longer. Usually the recessions, you see a quick collapse of the markets. So for in 1 year, we go back 5, 10 times, or 5 or 10 years. To give you an idea, the S&P 500, when it collapsed here in 2000, actually this is not going to help us, SPX. When the market collapsed here in 2002, we were back up here at levels from 1997. So effectively, we lost about 15 years. At the same time here, when the market was here in 2009, it was all in 2009 we're all again back to 1997. So that was levels that were available for us in 1997. What I told myself when we were trading here is that the economy was effectively telling us, or the stock markets were effectively telling us, that we're back at the same levels that we saw 20 years ago. And anybody realistically, anybody with a normal mind would say, of course, the US economy and the world economy has improved over the last 20 years. And we drive better cars, we eat better food, we have better housing, maybe the music is not as good. That's what some people would say. Maybe people are slightly more rude than they were 20 years ago. However, economy-wise, we're definitely much better. So that's one way of you can looking at it. Another thing as well, you see a collapse of all these stable stocks, like people that produce trucks, people that build homes, people that like pharmaceutical companies. But probably more, sorry, got carried away there, but probably more companies that produce trucks. For example, Volvo Trucks is a good one. You got a Renault, the French brand, anybody that creates a truck, right? You have Caterpillar that does all the big machines and so on. So obviously in a recession, people don't want to buy a new truck because there's not going to be enough business around. So they don't want to buy a new truck. They don't want to buy a new excavator or something like that. But 3 or 4 years in the future, when everybody has calmed down, people would like to buy a truck. So that's how people think when we're at these lows, the clever people. People that are not very well served, they will get panic and they will just sell because they think the world is going to collapse, which it usually doesn't do. Another thing as well, which is quite interesting. Do you remember, guys, the crisis in Spain, Italy, and Greece when the euro was about to break up? Someone invented the acronym PIGS for these countries because they were greedy when interest rates were low, then they built too much, and then people said, well, southern of Europe, the housing market there is never going to bounce. There's not going to be any flourishing. Europe is doomed. I'll tell you, it doesn't work like that. Of course, for a few years, you had all these buildings, and all these buildings had amazing kitchens, amazing appliances. So obviously you're not going to go and buy a new kitchen. You're not going to go and buy a new car, because if you're a constructor, you're not constructing as much as before. But give it 5, 6 years, when everybody calmed down, when some of the debt has been paid back, and you start to make some money. You don't have as much debt as before. Everybody's slightly more happier, and you look at your car in the garage way, and it's 7, 10 years old. Right now, it will be like 10 years old or something like that. People would like to upgrade. So what do? They buy a car. They go to the local car dealer. They buy a new car, and then people want to have a new kitchen. People want to extend the house. So you have these business cycles. They expand like they're doing right now. Like in the US, unemployment rate is low. Europe, unemployment rate is low. Inflation is low. So people are making money right now. And then eventually, of course, it contracts. And then after that, the recession sometimes. And then after recession, people don't spend for a few years, but a few years later, they're spending. But if you buy stocks when people are already spending, then it's probably going to be a bit too late. So long story short, ETFs. ETFs is for the long-term stuff. For the short-term stuff, like a broker like ATFX is sufficient. It's what you need, actually. Because the problem with buying ETFs is that the buying is not always in real time. So we got a question here from Chris John. What's my thoughts on the NASDAQ? So the NASDAQ 100, I have a bullish outlook. I had the bullish outlook for quite some time. I do a daily market update on investingcube.com at 9:30 a.m. London time. If you sign up to the WhatsApp channel, you will be able to take part. I'll send you the update. So in this, that's me, by the way. I talk about the markets, and this is from earlier today. So I turned really bullish on the NASDAQ 100 when we took out this high on October 28th, because we were trading upwards and we had this, we'll call an ascending triangle, and the market broke here and started to move upwards. And on the break to the upside, the target of this pattern, which is an ascending triangle, is up here. We still haven't reached that target yet, but I would just track this trend and try to buy on dips. If you didn't buy already, you probably need to buy on a dip between 8,266 and 8137, and then try to push it to the upside. And people that bought it here are probably already booking a bit of profits and just trying to track the market with the stop. There's a question, would the recording be available for the summit? I think what we're gonna do here is that we're going to take all the presentations and present them as individual recordings. That's probably what we're gonna be doing for the summit. We're probably gonna put it here in the menu at one point, but the production of the recording is probably gonna take a bit of time. It's not gonna be uploaded like a big file in one go. It might take a few weeks before everything is up. Okay, we're gonna wrap things up. I want to thank you so much for joining me. Do stay in touch. Please follow me on. Actually, I got a question here. I missed that. Sorry about that. I got a question from Diana. So what's the software interface I use to trade? So this is just for my chart analysis, and the chart analysis I use a TradingView. They're quite good because I like the charts. They're easy on the eye. But for trading, ATFX and their MT4 platform is really good. Let me send you a link. If you want to try out the MT4, let me send you a link. That would be good. So please use this one. Let me see here. There you go. And you can just download a demo account here. And that's going to be able to play around. It says Forex demo, but they have access to indices, currencies, cryptocurrencies, and commodities. So I got a question here by Samir. When is the best time to buy the stock markets? The trick is not to actually try to figure that out when is the best time to buy. Because we're using this averaging in method, so you would effectively buy a little bit every month. So say that you save 10% of your income. You should always have a fund with, again, with emergency funding. It could be, depends really what you can save. Not everybody has the privilege to save a lot of money, but it's always good to have a few months of saving just liquid in case you lose your job, you get ill, something happens, you have some liquid money. So that's number one. Then what you can do in parallel is to save some in stock indices. Um, and here it really depends on you, but we're looking at, again, buying a little bit every month, because what happens, as per that slide I showed you, let's see if I can find it again. So the idea here, you buy here at 10, and then you buy a bit more at 8, and then when the market goes back up at 9, you made some money on the first one. You lost money on the first one. You lost 1 unit, but you made some money on the second one. And if you consistently do this over a long period of time, then you get a very nice averaging price. And when you do see a big slide, so when you do see a big slide in the S&P 500, for example, when you do have these strong declines like this one, like a 7% decline, you can buy a bit more. And really, when you get like, let me check this, by the way. When you do have like these recessions where you have at one point, then you really want to buy more. So just to give you an example, you would usually buy for 200 pounds a month. And then when the market declines a lot, you want to buy more. So you buy maybe for 400 pounds. You just need to remember, if you need the money within 2 years, then it shouldn't come into this pot. If you're saving for a house, as an example, and you know you're not going to buy the house or the flat within the next few years, then yeah, you can put your money in the stock markets. The problem is that sometimes, once in a while, you'll have that massive decline, and you definitely do not want to sell at that point. I can't tell you what you should be doing, but I wouldn't be selling at that point. I would just be buying more, and I would keep it. Again, it doesn't apply to all markets. As you saw in the S&P and the Chinese stock markets, some of these markets are very high volatile, and at the end, they don't give you nothing. There is one, like the FTSE 100. Unfortunately, the FTSE 100 is not really an efficient market to invest in, because really, since, well, it hasn't done nothing really since for the last 19 years, more or less. It's up with 0.5%. You do get some dividends, of course, but unless you bought down here, you would not have made a lot of money. So some markets are not suitable, and this has to do with the fact how this is constructed. The FTSE 100 is an index that is not necessarily reflective of what's happening in the UK. You have the FTSE 250. I'm not sure I have it here. that is a better option because it includes smaller companies. Unfortunately, we don't have too much data here, but from the 2018 low, at least it has a bit of an uptrend. Okay, guys, I want to thank you so much for joining me. I think it was amazing. Join me. Let me see here. I just got one final question. I think in general, again, there are ways of dealing with your positions, right? So if you're trading short term, like with the Nasdaq 100, the market is in an uptrend, so you want to be buying, but you have a very tight stop loss. We buy here, stop loss goes down, which means we risk 1.2% most if we use no leverage. And this is a different strategy than the long-term one. The longer-term one, which I mentioned here, you hold positions for a few years and you sell when you're in profit. That's a bit of different. And the whole idea is that we don't try to time the market with that money. We just buy a little bit every month we buy a little bit, okay? With the short-term stuff, if you trade with a broker with like ATFX, it's a different ball game altogether. There you would effectively be more active. There's no hard rules how much money you need to allocate to trading with a broker like ATFX. But the general idea is that whatever you trade on margin, you should be able to lose that without that affecting your lifestyle. A lot of people that put too much money, they get money from friends and families, children's college fund and everything, and they lose. That's a bad strategy. If I lose all my money on my trading account, it's not going to change my strategy. It's not going to change my lifestyle. I'm not going to be very happy, but it's not going to change my lifestyle. And at the same time, investing in this longer term, as I said, that's for bigger projects, buying another place, for rental income, or retirement. And you don't want to play around with your retirement money. You want to invest. So when you do retire, you have something to rely on. On the other hand, because you're less active and it's less risky, the returns are lower. All right, guys, if you do have any questions, let me know. As well, you can reach me via email at alejandro.zambrano@atfx. Thanks so much for watching and have a great day. Thank you.